In this video, we explain how we apply the rather complex rules to calculate how much pension you receive each year. The Centrelink website has a calculator you use to submit your details each year. Their calculation may differ a little from ours, as we don't apply the finer detail of some variables, but our calculation is done to give you an approximate outlook of how your retirement financials will look. Some financial advisors and super funds offer an online calculator as well. The basis of their calculation methodology is not stated, so should be used with caution. The Can I Retire Planner employs the methodology demonstrated here, adjusting values each year based on the projected CPI you choose in the planner. We also apply the rules as they stand right now to the balances going forward. On a regular basis, politicians change these rules and we cannot forecast those changes. The best way to explain the calculation is with an example. In this example, Peter and Mary want to retire. They are 73 and 69 respectively. A couple own their own home, and Peter is still earning some personal income from his consultancy. They have assets, liabilities, and personal income as listed in this spreadsheet. The family home is valued at 1.1 million and, according to the rules, is not assessed. This could be valued at propertyvalue.com.au or realestate.com.au. Home contents is included in the assets test and valued at market value, not replacement value. Most households have no more than $10,000, as this is the pricing you would get on Facebook Marketplace or a garage sale. It is not the replacement value used for insurance. The total value of any motor vehicles you own outright. The easy way to calculate these values is redbook.com.au, which gives a range from low quality to pristine from which you can choose. Cash in bank, term deposits, investment portfolio, and any form of superannuation account are assessed for the assets test and are included in the deemed income calculation. Peter and Mary still have a mortgage, and the mortgage offset account is assessed for the assets test and are included in the deemed income calculation as well. They also have an investment property. This is assessed less the outstanding loan shown under liabilities. The loan can be deducted only if not secured against the family home. In that case, the loan is not assessed, as it is technically covering an unassessed asset. The credit card and home loan debts are not assessed. The investment loan is deducted from the value of the investment property if secured against the investment property. The rental income is assessed under the income test. This is the net income after allowable deductions specified on the Centrelink site. These do not include all deductions allowable for tax purposes, and you'll need to check this carefully when applying for the pension. Finally, Peter earns $15,000 in wages a year from his consulting business. To establish the pension you are paid fortnightly, Centrelink calculates your entitlement under the assets test and under the income test. You then receive the lower value of the two results. Okay, let's work through the asset test calculations for this example. Non-financial assets are not subject to deeming and include home contents, motor vehicles, the investment property, and associated loan. Financial assets are subject to deeming and include cash at bank, term deposit, investment portfolio, and the superannuation pension account, all subject to deeming calculation. This gives total assessable assets of $905,500, which exceed the couple lower asset threshold of $470,000, as will be shown under pension data on the summary tab of the Can I Retire Planner. This means Peter and Mary have assets over the lower threshold of $435,500, which means their pension is reduced by $1,307 a fortnight, calculated as follows, giving a fortnightly pension of $279. Now, let's apply the income test. Peter's work income fortnightly is his annual income divided by 26. Because he has work income, the work bonus of $300 per fortnight is applied to reduce his income. Deemed income is calculated as 0.25% of the assets up to the deemed income asset threshold, plus 2.25% of assets over the threshold, like this. Net rental income is the annual income divided by 26, which makes a total of $1,276 assessable income. Subtracting the lower income limit fortnightly means there is $904 over the limit, resulting in a pension reduction of $452, calculated as 50 cents in the dollar. The income test indicates a pension of $1,133 per fortnight. As the assets test produces a lower pension, the net result is a pension of $279. So, how is the pension calculation applied in your planner? Let's use the example in the How to Use the Planner Summary tab video. Pension data marked CPI adjusted is incremented in March-September each year. Our model adjusts the values annually at the chosen CPI rate in the table. Obviously, the reality is the values will move based on actual CPI. But as this is the CPI average over the last 32 years, it's a pretty close approximation. Here we have added two plots to the super closing balance chart, showing the adjusted upper and lower asset limits over the plan period using the CPI. At age 77, the upper limit exceeds the balance, but the estimated assets is included in the asset test, so it is not until age 79 super balance plus personal assets drops below the limit. In that year, the pension paid calculates at $994 for the year, or just $38.20 a fortnight. Seems pretty low, eh? It is still important to apply though, as pensioners receive all sorts of additional benefits that make this amount worthwhile. Let's assume this plan is for a single person now. Here you can see the balance chart changes and the upper and lower asset limit plots are different due to the pension data being different for a single person. Clearly, the person doing this plan needs to consider lower annual expenses, as these were the expenses for a couple. But the calculations show a pension is now available 6 years later at $8,100 per year, or $311.53 fortnightly. The Can I Retire Planner uses data published by Centrelink and calculates an approximate pension for each year applying CPI adjustments. This demonstrates what your financial plan will look like, including pension payments. Please consider the disclaimer, as we can only estimate your pension as it is calculated each 6 months by Centrelink based on data updates from you and changes in rates and policy. If you haven't already reviewed the Can I Retire Planner, you can do so by clicking on the link below to view details about how it works and how you can get your subscription.